Despite the ongoing tensions between the United States and China, the number of Chinese companies raising capital through IPOs on U.S. stock exchanges reached a 10-year high in 2020. According to a list published by the U.S. China Economic and Security Review Commission, as of May 5th, 248 Chinese companies were listed on American stock exchanges, up 14% from 217 only 7 months ago last October. A total of 39 Chinese companies were listed on American exchanges in 2020. What are these Chinese companies and what are the risks? Hi, welcome to my show. I'm Lei. And it's not just the number of Chinese companies coming for IPOs has increased, but also the amount of capital that's involved. According to the South China Morning Post, in the 12-month period ending this past April, Chinese companies have raised a total of $17.6 billion in the U.S. capital market, more than 4 times the $4.1 billion raised during the same period a year earlier. Of all the companies that have been listed in the past 16 months, since the beginning of 2020 to April, 43% are in strategic Chinese industries that compete with the U.S., namely information technology, biotech and pharmaceutical, energy and industrial manufacturing. I'm not saying all these companies aim to directly competing with the U.S., but their success is certainly strategic in the eyes of the Chinese Communist regime. For example, cloud computing is an area that China is very ambitious about. An article from May 17th in Financial Times discussed why the cloud has become the new frontier between China and the West. There are a few Chinese companies specializing in cloud technology that went public in the U.S. capital market recently. Cloopen is the first and the largest cloud communication platform and service provider in China. It's backed by Chinese tech giant Tencent and Sequoia Capital China. Cloopen aims to compete with the leader in cloud communications, Twilio, which is a company based in San Francisco. Cloopen is sometimes called the Chinese Twilio. Both companies are listed on the New York Stock Exchange and has a market cap of $1.5 billion and $55 billion respectively. Kingsoft Cloud, a subsidiary of Kingsoft, which is a major software company in China, whose chairman is Lei Jun, Xiaomi's founder and CEO. Kingsoft Cloud is said to be the 3rd largest Chinese cloud provider. It is listed on NASDAQ with a market cap of $8 billion. Tuya, which just got on the New York Stock Exchange this past March with a $14 billion market cap, is an Internet of Things or IoT operating system provider for enterprise businesses using cloud technology. Its goal is to become the standard-setting global leader for the IoT industry. At the 2018 Consumer Electronics Show in Las Vegas, Tuya announced the launch of the U.S. version of its platform, which helps manufacturers transform standard products into IoT products or smart devices and upgrade traditional supply chains with artificial intelligence capabilities. Currently, Tuya's partners already include Amazon Echo, Google Home, and Apple HomeKit. It claims to be the world's only platform that connects these gadgets on a global scale. Here's what Tuya's CEO Jerry Wang said about Tuya. From homes and schools to office and factories, smart living will become a norm in the highly connected IoT world of the future. Tuya hopes to be the gateway to this smart world. We see tremendous business potential in the connected lifestyle, where data understands everyone's needs, preferences, and habits. It sounds pretty good, and I'm not against technology, but I'm concerned about the Chinese version of digital utopia. The question is, who controls the data? The security concern over these smart devices running on Chinese operating system sharing data with the Chinese regime needs to be addressed, just like the security concern with WeChat, TikTok, and most recently Clubhouse. By the way, Clubhouse is powered by the technology from the Chinese firm Agora, which is a Shanghai-based technology firm that went public recently on NASDAQ. When Chinese tech giants obtain the data from smart devices, it inevitably falls into the hands of the Chinese Communist Party. These businesses don't have control. Isn't that the struggle Jack Ma and his companies have had with the Chinese regime? You can watch my previous video on Jack Ma to understand the risks of investing in Chinese companies. When Jack Ma's Alibaba went public in 2014, no one in the Western world could have predicted that Alibaba will one day be fined by the regime just because it's too successful. These unstable political factors are the unique risks of investing in Chinese companies. On the other hand, if my retirement funds are used to help these Chinese tech companies grow at the cost of my privacy, I should be concerned. China will have 560 million surveillance cameras installed by the end of 2021. That's one camera for every 2 people. Beijing now leads the world in having the most surveillance cameras in a city, over 1.2 million of them. These cameras use facial recognition technology to monitor people's whereabouts and activities. The data is combined with the data collected from various social media platforms, as well as e-commerce and digital payment systems such as Alipay and WeChat Pay. The Chinese Communist regime is pushing for a digital society through 5G, facial recognition, and AI. One of the Chinese companies that went public last year is Blue City. It's the world's first publicly traded social media platform for the LGBTQ community. The app tracks personal data and uses facial recognition in detecting the user's age. It's now the largest gay dating app in the world with 40 million users, 30% of which are outside China. I'm concerned about the privacy and security risk for the LGBTQ community if the Chinese regime gets control over the data, if it hasn't already. And another Chinese company I want to mention is Yalla. Founded in 2016, it's headquartered in the United Arab Emirates. Within 4 short years, it became a publicly traded company on the New York Stock Exchange. Nicknamed the Little Tencent in the Middle East by the Chinese, Yalla is a voice app that serves people in the Middle East and North Africa. It's called that because it uses Tencent's strategy. The positioning of its social media plus gaming product portfolio is the same as that of Tencent when it first started. By the way, Tencent is the Chinese tech giant that owns the do-everything app WeChat. And WeChat is notorious for security risks as it's used by the Chinese authorities for censorship and surveillance on a global scale. Although Yalla's headquarters is in the Middle East, its development team is in Hangzhou, China. Yalla offers its app in 8 languages, including Arabic, Turkish, Spanish, and Portuguese, but not Chinese. In fact, the company website doesn't mention anything about China. Its founder and chairman is Tao Yang, the former general manager of ZTE Corporation, Abu Dhabi branch. During the pandemic, Yalla grew fast and has become one of the most popular voice apps in the Middle East. Maybe its ambition is to become the Tencent of Middle East. That would surely be a security disaster for people in that region. 50 years ago, oil was a strategic resource. Today, it's data. Whoever controls the data controls the world. When we invest in these Chinese high-tech companies in the U.S. stock market, are we helping the Chinese Communist Party build its digital utopia? Let me know your thoughts. Leave me comments. I will follow up on this topic in my future videos. To get more information on China's investment in the U.S., watch my video, Schools Bought by China. Here is the video on Jack Ma's struggle with the CCP. Please subscribe and share, and thank you.